There's definitely a disconnect between the way clients are feeling, the way the retail investor is feeling, and what is happening in reality. And I'm not 100% sure. You asked what to attribute that to, and I don't know the answer. I can just say that it exists, and it existed last year too. It's probably not a coincidence that we're still in this post-COVID world where a lot of indicators and correlations are not working the way that they used to. And so there's confusion, not just among retail investors, but among investment professionals as well. People who have relied on certain correlations to work in order to build investment allocations. Those things have broken down almost entirely. For instance, last year was the worst year for the quote-unquote 60-40 portfolio since the Great Depression. A 60-40 portfolio is a portfolio that's 60% stocks, 40% bonds. There's no need to complicate it any further than that. The reason that did so poorly last year was because it was the first year where the Fed started raising interest rates. So interest rates went up a great deal last year. They have continued to move higher this year, but last year they went up a lot, which put downward pressure on bond prices. And we can maybe get into why that is later in the video or in another video. Bonds did poorly last year, and also stocks did too. At this point, everybody knows last year was a really bad year in the stock market, especially the NASDAQ. But the S&P was down almost 20% as well. So a portfolio of 60% stocks and 40% bonds was down mid to high double digits last year, meaning between 15 and 20%. That's really bad for a diversified portfolio and people who invest somewhat conservatively, and they're not counting on that. And historically, it's very rare for stocks and bonds to move in the same direction. Usually, if stocks do poorly, you can sort of bank on the fact that money is flowing into bonds because bonds are viewed as more conservative, and therefore one offsets the other. That didn't happen last year. This year's a little bit different. So stocks have recovered, but bonds have not. So the Fed continued hiking interest rates into the first half of this year. That has slowed now, or it's stopped. But that put continued downward pressure on bonds. If you look at an index of treasury bonds, long-term treasury bonds, they've done so poorly over the last 18 months, it's almost hard to believe. And stocks have rebounded a little bit. So it's sort of weird. You're getting positive contribution to a 60-40 portfolio from stocks and continued negative contribution from bonds. So I think this is a long-winded way of explaining why sentiment is so bad. It's just because any investor over the age of 50 probably has some exposure to bonds. And so they're watching a part of their portfolio that for years has been steady and reliable. And all of a sudden, it's giving back a huge chunk of what it had gained over the previous 10, 15, 20 years. That's scary because that type of volatility is usually appropriate for a younger investor, somebody who's investing for a very long period of time and they don't need their money in the next 5 or 10 years. But somebody who's over 50 is probably getting close to retirement, at least thinking about it. And so when they're seeing negative returns, when they're invested in an appropriate way, I think that just sort of sends some shockwaves through the investment community. I don't think people in their 20s and 30s are feeling particularly stressed, but those aren't people usually with large net worths who are, we don't think of them when we're talking about the investor class. We think of the people with the largest balances in their portfolios, which are people who have spent decades accumulating wealth. So I think that's an explanation for why sentiment is so bad. People are scared. People are scared that they can't rely on assets that previously they've been able to rely on. 100%. That is the reason that for the fear of locking in. It's the fear that rates are just going to be higher in the near future, and therefore why would I do that? It's sort of the same logic when it was working the other way when rates were falling, and people were saying, well, I'm not going to lock in my mortgage now because rates are just going to be lower at some point in the future. It's the exact same logic. Like, why would I invest in a bond with a fixed rate of return, fixed coupon, when I feel very confident that I'm going to be able to wait and then invest that cash at a later date for a higher rate? And so we're seeing that psychology play out. People are afraid to invest in bonds right now, which, it's funny because I think people weren't afraid to invest in bonds when rates were much lower, and they should have been, because what happens when rates are really low is you're putting yourself at a risk that if rates rise, your bond is going to be worth less on paper. But to address the second part of your question, do I think that the Fed is done? I do. I think that they've all but told you that they're done. But again, there's this fear amongst people who have just watched this enormous move in interest rates and their bond portfolios. That fear, I think, is dissuading them from feeling confident that the Fed actually is done. When really, if you just look back at the last 24 months, the Fed very well telegraphed what they were going to do. They said, we're going to start raising interest rates, and we're not going to stop until we feel inflation has been reined in. And now what they're both telling you and signaling that they're likely done, that they're certainly close to done, and maybe entirely done. And they're doing that with their words and also with their actions, because the last 3 Fed meetings, they have announced that they're not hiking interest rates. Those are the first meetings that they haven't hiked interest rates since this started about almost 2 years ago. So the Fed funds rate has stayed about the same, or stayed exactly the same, and we've also started to see bonds start to, sort of get their footing. Rates have stabilized, bonds have stabilized. It's sort of like the whole world is adjusting to this reality that, oh wow, maybe this the earthquake is over. And that's really kind of what it's felt like. The Fed arguably was late in tackling inflation, and then they made up for that by going really, really fast, raising interest rates by 500 basis points in a very short period of time. And that's just, it's sent shockwaves through the bond market and through the stock market last year more than this year, and more importantly through investor psyche. There are certain people that believe that the Fed dictates what the market does, and then there's other people that believe that the market dictates what the Fed does. And there's probably a gray area. There's probably some truth to both. But what you could see before the most recent Fed meeting was a lot of volume in the TLT ETF, which is simply, it's an index fund that tracks the performance of long-dated Treasury bonds. It's the most widely held vehicle if you want to make a bet on what long-term Treasury bonds are going to do. The volume had started to pick up before the Fed meeting, which all that means to our listener is that people were starting to bet that rates were going to go down, that the long end of the curve had exhausted its move, and that all of a sudden there's some value in long-term Treasury bonds. And then what we saw was that the Fed did make their announcement that they were going to pause yet again, and their language was a little bit softer than in previous meetings, and as a result of that, we saw the Fed fund futures start to price in actual rate cuts starting in June of next year. That's the first time that there were cuts actually priced in for 2024. So what the market is suggesting is that the Fed's work has been done, and that interest rates are more likely to go down than up if you look out 6, 9, 12 months. You have to dig so far to find good news, which is, it's kind of crazy. The headlines are all negative for a variety of reasons. Some of the reasons are good. I mean, there's bad stuff happening in the world. There's 2 wars at this point. One started in 2021 with Russia invading Ukraine, and then obviously we've got Hamas and Israel going on within the last month. That started. And some people blame the Russia-Ukraine thing on Some people blame that for the spike in oil prices, which carried through to inflation a little bit. I think that's far-fetched, to be honest. I think inflation, the inflation story started before that. I think it's more to do with, there's a little bit of contributing factors with the fiscal stimulus as a result of COVID here in the United States. But I think a lot of it was broken supply chains, which started with COVID. Tariffs on China, which interrupted supply chains even before COVID. And then inflation just kind of becomes a self-fulfilling prophecy at some point. And the Fed finally stepped in and said, okay, we're gonna quash this. And it's gonna take a little time. But ever since that, basically, ever since COVID and then the Russia invasion, it's been nonstop headlines about how we're waiting for this recession. Bad things are coming to the economy, and you haven't been able to convince anybody otherwise. However, we haven't had a recession, unless you consider the first 2 quarters last year, 2022, which were negative GDP quarters. There was a lot of hemming and hawing about whether or not that constituted a recession, because unemployment never went up. So it was not labeled a recession. We're still seeing the same number of headlines, and prognosticators are still absolutely convinced that we are going into a recession. It's just a matter of when. Now, and on the other side, you've got the Fed saying that we are trying to engineer a soft landing, and we're confident we're going to be able to achieve a soft landing. You saw some headlines from the European officials yesterday suggesting the same thing. And Yellen has really been adamant that we are expecting a soft landing. All that means is that we're going to bring inflation back down to the Fed's target, and we're going to do it without causing major disruptions to the economy, without GDP going negative, and without unemployment spiking. Those two things tend to go hand in hand. So far, much to the dismay of negative prognosticators, that's what's happening. We have seen a small spike in unemployment, but there could be other reasons for that, and there's no guarantee that it's going to become anything worse. And we've seen positive revisions to GDP lately, like you've suggested. And what's also happening is that we're sort of, we've talked on previous videos about how the market can determine what happens, because the stock market is a leading indicator. And if last week did in fact turn out to be a pivotal moment for both stocks and bonds, and I'm not pounding the table on that, but it sure felt like it to me. It really felt like last week that with the Fed meeting and the massive volume into the TLT ETF, I think that was really a sort of an emphatic display of the direction or a ceiling on interest rates. And I think that put a floor. So there's a ceiling on interest rates and a floor under stocks and bonds. And to me, that may actually dictate what comes next. So if we're able to rally in stocks or it not fall apart between now and the end of the year, I think there's room for positive news in terms of what the headlines are saying. And then all of a sudden, we're seeing less confidence that a recession is around the corner, and companies start to feel better when their stock prices go up, and they don't need to proceed with the layoffs that everybody is projecting. So there's a lot of room for what could go right, just in terms of the market sort of getting ahead of the economy and headlines.